All right. Good morning, everybody. It's now March. We got our March webinar. We're looking at, we got a lot of data in for the spring. We're looking at the real peak of the spring buying and selling season coming in. There's a lot of questions on the table that we'll get to explore today. I have a ton of data and we will dive in just a sec. So the questions I want to start with, the things that are that I'm spending time watching the data for, uh, are there new economic vibes that are maybe starting to drive the housing market? There are a bunch of new policies underway, things like tariffs and immigration and cutting government spending. These tend to be degrowth policies, slowing the economy. And so the question is, how does that impact the housing market? And do they turn into actually a slowing economy? Recession talk is back on the table. It's been on and off for the past like 3 years. It's back on the table right now. I'm going to go into a little bit of mortgage data and some of the economic data to start with and tell you where we are on that scale of what the assumptions. But I think there's an important question here is whether there are home sellers or homeowners now who are feeling economic changes in a different way than they have in a bunch of years. These are folks, and I've just started to hear anecdotally people saying, well, I want to sell my house before it gets worse. I haven't heard those kinds of sentiments since the basically this time in 2022. So it's worth considering, and I'll show you a little bit about what we have in signals in the mortgage markets. And for example, we can see the new listings data is starting to tick up and get closer to the old normal levels. So are those folks who are sensing new economic vibes? So that's a question that we have on the table, and we'll try to explore that as best we can. Um, there are pricing signals that are definitely softening across the country. So we are watching to know if the headlines, if the national home prices turn negative in 2025. There are some potential signals that that's happening. It's not everywhere in the US, but there are a lot of markets that have home prices that are down year over year. And if that happens, the headlines would change, so the message that home buyers and sellers are getting would change. So that's absolutely something to pay attention to. Uh, our home sales, on the other hand, our home sales about to turn positive. So home sales have been below 2024 for the whole beginning of the year, fractionally below, a little bit fewer every week, but it seems like we are about to turn positive, and I'll show you why that means. So we could be in a scenario where later in the year, home sales are growing, the number of home transactions are growing, but prices are down year over year. And so that's worth watching for. And then if that's the case, if inventory is rising, which are the markets that are most at risk? And we'll spend some time in the local markets later on in the second half of the conversation today. So lots to get to. Let's start. Before I dive into the data, if you're new to Altos Research, all the data that I do today, all the ability to take that data and to communicate with your buyers and sellers, with people who need to understand the housing market right now, they need to hear the data from you. And the whole point is that you are the expert to be able to communicate with buyers and sellers. So you can go to the Altos Research website, go to altosresearch.com. You can drop your zip code in there. You can get all the data for your local market. You can set up a free account and get rolling today to communicate what's happening with buyers and sellers. There's a lot of fear out there about what's happening next, about what changes in the economy. And the data is the antidote to the fear. So your clients need to hear the data come from you. It's fresh every week. There's always a story in it. There's always a reason to be in touch with your buyers and sellers, your potential folks. So, and we're in a moment where home sales may be about to start to climb. So If you're not already with us at Altos, I encourage you to go to altosresearch.com and drop your zip code into that box and get started. Okay, let's dive into the data. I'm going to start with mortgage data today, mortgage and economic data. So I mentioned that there are some vibes that are kind of changing right now. For the first time in many years, we have unemployment that's starting to rise a little bit. We have government cuts that are adding to that. The government cuts in DC are really not enough yet to drive like recession. And there's another factor. There's a couple of actually optimistic things in the mortgage markets that I like to point out. I noticed earlier this week that if you were lucky enough to refinance your home in 2021, 4 years ago, at 2.6%, the absolute low, we are right now at the tipping point where your principal payments are more than your interest payments on your loan. And so this is a really fascinating point for any borrower. What it really says is it communicates how strong a financial position American homeowners are in, because a lot of folks are in somewhere in there, already past the tipping point on their mortgage there, or they are, or sometime in the next year or so, if they refinance later in 2021 or even early 22, those folks are now at a really strong advantageous spot with their mortgages. It's a ton of the U.S. and that has implications. So even if we shift into a high unemployment recession, Americans still have this tremendous asset in their home that they're going to fight to keep, even if they're losing their jobs. And so I thought that was a really fascinating. So the tipping point is like right now in March, where your principal payment is now more than your mortgage payment. And that, if rates are higher, as the rate is higher, the longer it takes you to get to this tipping point. So the fact that we're already past this for so many millions of Americans is a really big deal for economic strength. So the other thing to note on the mortgage side is that as mortgage rates have been easing down this year and prices have been steady or climbing a little bit for the spring, the average payment that people are making is starting to inch down as well. And we can see the purple line here is 2025. The blue line is 24. In 24, last year, mortgage rates were climbing in March, April, May to hit their highest point of the year in May. And so over the next couple of months, if we're lucky and rates keep ticking down, then payments are actually going to be more affordable than they were last year at this time. It is this moment when it could be an opportunity that we see home purchases, like transaction volume, growing because that affordability matters. So mortgage rates peaked last year, payments peaked in May. By September, this is when mortgage rates came down to about 6%. And we could absolutely see the payments were much lower, from 2,500 down to 2,100 in September. At this moment in September last year, we saw transactions finally tick up. We saw surprising resilience for home prices. So you could really see that when the affordability was below the year prior, that was really meaningful. If we're lucky, the purple line continues to ease down through April, May, June, and helps to accelerate purchases in the second quarter when most of them happy. So fingers crossed there that we are in an opportunity for slightly improving home sales. I should say, mortgage rates are at about like 6.7 right now, 6.6, 6.7. Last year, when rates went from 7.5 down to 6.5, say in July, we really didn't see much of an acceleration in home sales. 6.5% was not enough. But when rates got close to 6% in September, that's when we were really able to see the needle move. So I think the takeaway on mortgage rates is that if we get closer to 6%, I think you're likely to see that again this year. If rates stay in the upper sixes, above 6.5, maybe we get a little bit of improvement over last year, but that's really going to keep a damper on home sales. And it's probably going to keep a downward pressure on home prices, which I'll get to in a minute. So really that closer to 6% is the threshold that we're watching for to see that happened like it happened in September. And you can really see what happens when the payments are that much improved, people start taking action. Okay. Let's move on. The other optimistic thing in the mortgage markets is that the MBA's purchase mortgage application. So how many people are applying for a purchase mortgage each week is inching a little higher than last year. So the purple line for 2025 is a little above last year. These are for sales that are going to happen hopefully in the next month or two. So that is a nice leading indicator that kind of starting to jive with the other indicators that hopefully show home sales growth year over year in the second quarter. So fingers crossed that we have a little bit of optimistic momentum in the mortgage markets right now. Okay, so let's switch to the Altos data. So the weekly pending home sales. There were 66,000 single family newly pending home sales last week. And you can see that it is just the same level as 2024. And most of this year, we've been trending each week with slightly fewer home sales than the week before, than the year before. So the purple line was slightly below. But what we know is March, April, May of 24 was when mortgage rates spiked the most. And so the growth in home sales got delayed. And so if we're lucky and rates continue to ease down, we could see the 25 line start to trade above last year. That would imply the headlines start to have positive home sales growth. You'd feel it in more transactions. There's not a lot of transaction catalysts. Like I said, it's like if rates fell down to 6 or so, we would see a notable change. So last year, May is when rates peaked and sales dropped really fast through the third quarter. But they stayed elevated here horizontally here in September and October because that's when rates fell again, right? So buyers are waiting to see opportunity before they act. But I anticipate in the next few weeks, March, April, May, that we will see sales ticking above last year. We still at Altos and Housing Wire, we have a forecast of 5% sales growth for 25 over 24. We've been coming in below, so it's got to turn the corner. It may be right now turning the corner. If, on the other hand, rates spike again, because who can predict rates? Like they feel like they're easing down finally, but there could be economic data or policy data that drives rates higher. And if that happens, then I think the consumers, potential home buyers are very sensitive. If rates were to spike, I would expect the sales number to turn worse and to not get any growth for the year. But I do expect we will probably be turning into the data looks like it's going to come in with starting to get a little bit of home sales growth over 2024. So that's a little bit of optimism in the numbers. Let's look at the total number of sales. So that was the weekly sales. And because each week has been a little bit below last year, the total number of homes in contract. So right now there's 333,000 single family homes in contract. Last year it was 345,000. So we have to have a bunch of weeks of improving sales before the total number climbs. These are the homes that are in contract now are generally going to close in the rest of March and in April. And so the headlines of home sales will be the weekly numbers will start ticking up, but the total number of sales is still going to come in a little bit lower until we have these home sales, like the total number in pending to start climbing. So right now it's 3.5% fewer homes in contract than 2024. By the April webinar in a month or so, I'm going to guess that we probably are like a little bit above 2024. So fingers crossed that that's what we're looking at on the home sales side. Let's switch to supply. So there are 655,000 single family homes in contract right now. That is 29% more than last year at this time, about 500,000 last year at this time. It is getting close to the 2018 and 2019 number. These are active inventory. And you can see in the 10-year curve here, we had in the last decade, mortgage rates were basically falling each year, and cheaper rates mean it's easier to buy and hold properties. So we resell less. So lower rates means lower inventory. Rates plummeted in 2020 and 21. So during that period, inventory plummeted as well. Then starting in 22, right about this time 3 years ago, rates started climbing. And so we have 3 years of climbing inventory, 3 years of climbing rates, 3 years of climbing inventory. There's no signal that mortgage rates are going to drop like below 6 this year. But if they get close to 6, that'll keep a lid on the total number of total unsold inventory. If rates bounce back over 7, that's going to accelerate this, and we're going to get much closer to the old normal levels of inventory back here in 2018 and 2019. You can see back here in 2018 to 2019, that was a year of rising mortgage rates. There was economic tightening, so rates were climbing. And so when rates climbed in 2018, that broke the trend of a bunch of years. So rates climbed, inventory climbed. And the same thing is underway for the last 3 years. And if rates jump again, that will mean that inventory will continue to jump. If rates dip from here, then that'll mean we'll buy more, we'll hold more, we'll resell fewer. And so we'll go from, we'll finish the year at a less steep slope. So that's where we are in current inventory. I think the real more compelling story right now is the new listings count. So in this view, there are 68,000 newly listed single-family homes unsold this week around the country, and you can see the purple line here is 2025. So 68,000, just over 68,000. You can see how many more last year at this time. There was only 59,000 single-family homes. And these lines up here, 2019, 2017, 2018, all of these lines here were the pre-pandemic years. So 68 to 72,000, 78,000, we're getting closer to the old normal levels of sellers each week. So we've been in multiple years. You can see here's the 2020 line. See this gray line here is 2020. This is the start of the pandemic. We stopped selling and we started buying everything in sight. So then we've had multiple years with very few new listings each week. We are finally emerging past that. So where are these sellers coming from? I think there's 2 main places that these sellers are coming from now. One of them is pent up supply. These are folks who have waited to sell their homes for 3 years. Some of them have been waiting to move. Some of them have been worried about, unemployment is low. but job hiring is very low. So if I quit my job, it's still it may be difficult or maybe scary for me to think about getting a new job. So we're moving less, we're quitting our jobs less, we're relocating less. The migration patterns are way down. And so, but we've been held off for 3 years. So some of the new listings now are people who have been holding off for a few years. As I mentioned at the beginning, the other place that might be coming from are what might be called the first of a uh, bad economy kind of seller. So there are people who are sensing shifts in the economy, even though it's probably a long time before any recession might hit, even if all the negative things play out, where still companies still have good profits, people are still very employed, even though unemployment is rising. I mentioned how much economic strength homeowners have because their mortgages are in such good shape. So those things will keep us from, reverting into recession quickly, even if we had put in some really dramatic tariffs that really slow down the economy. So, so what that probably implies, though, is that there could be new sellers right now who are seeing those things and saying, "I want to get out of DC or out of Dallas before things get worse." And so we saw, like we haven't had that kind of vibe for many years. So it literally has been like 15 years since we've had bad economy vibes that really scared people. So we don't have a lot of sellers. It's still, the purple line is still below the old normal lines, but it's growing from the last few years. What I'm watching for is, does the purple line start to get above the old normal levels? And if that's then that implies supply is growing faster than demand, and that will then lead to assumptions about home prices in the future. And there are markets where supply is growing faster than demand, and I will share some of those local markets with you in just a minute. So, as of right now, the national story on new listings, we're getting closer to the old normal. That implies that supply will continue to grow. That implies that therefore there's a cap on home prices, home price appreciation in most of the country, and maybe even some home price declines. All right. So supply is not growing evenly across the country. In this view, the more purple the state, the more inventory growth versus last year. So it's actually fascinating. So total number of homes more sale is Florida. Florida has the most growth in inventory total numbers, but Florida also always has more homes for sale than say California. So California right now leads in the greatest inventory growth percentage wise year over year. Um, Florida and Texas have been percentage-wise leading for a long time, but they have more homes, so their percentages are a little bit lower right now. But you can see where the West and the South are, where significantly more inventory than a year ago. However, Connecticut is still 10% fewer homes on the market than a year ago. New York is just 5% more. So you can really see the North and the Northeast where we are selling fewer. And we've been selling there and moving south for a bunch of years. That migration pattern has slowed way down because it's more expensive right now and more expensive to move. And it's difficult to find a job in that I have a good job wherever I am and I don't want to quit it and try to find a new one. So we've slowed that migration. So we're not selling in Buffalo and we're not buying in Tampa in the way we have been in the last decade. And so therefore inventory is lower in Buffalo, it's lower in Bridgeport, Connecticut, and it's much higher in Tampa and across Florida and Texas and much of the South and West. So the more purple the state is where the more inventory is. And you'll also notice that when I go into the pricing, pricing is weaker across the South, and it's much stronger across the Rust Belt, the North and the Northeast. So, and we'll do a little bit more on that, and then we'll dive into pricing and then dive into the local the local markets. So let's wrap up the supply story with the projection of where inventory grows through the rest of the year. So the dotted line is the forecast week by week that we have for inventory, and you can see that by the end of the year, it looks like we are going to be back at the old normal levels of supply. And so that implies to me that we have a lid on home price appreciation that we haven't had in many years. So we've had in the last few years, even though home sales were lower, home prices kept pushing up because supply was low. But really looks to me like that story is finally changing after a bunch of years by the end of 2025. And I think that has significant implications for home price appreciation next year and long term, and even some in this year. So I think we adjust this forecast every week when the latest data comes in, so we can expect inventory to keep climbing. There'll be a dip for the Easter week, and then in the old years and old times, inventory would peak in like June and July and August. In the more recent years, inventory has been peaking in October. So we have forecast inventory to peak in October this year again. If mortgage rates were to fall dramatically, and say they fall close to 6 and stay lower to 6 during the year, then that is going to bring this forecast down. It'll compress it down, and we won't get quite to the 2019 levels by the end of the year. If rates were to fall into the 5s, for example, I think that would spur demand a lot quicker than supply, which it means that this forecast would compress and maybe even start getting close to the 2024 levels. So lower rates creates lower available inventory. Higher rates creates higher available inventory. And so you could see, as you expect rates to stay higher for the year, inventory should continue to grow. We expect to be about 19% growth by the end of the year. So that's the forecast of inventory. Let's switch. One last bit here before we go into home prices is the days on market. So one of the reasons that even as the new listings volume, the seller volume has been pretty restricted. It hasn't yet gotten to even old normal levels, let alone more than normal, but it's taken 10% longer. Every home sits on the market longer. So inventory builds because of because demand is lighter. So in this, each bar is a week, and the taller the bar, the longer days on market. And so you can see that we are at 78, 79 days right now. We're just past the peak, starting to decline for the rest of the year. Compare that to last year at 71, and somewhere back here in 2 years ago was 70, and then 3 years ago it was like 35 or something coming out of the pandemic. Okay, so days on market's a little longer, and that's part. So let's switch into pricing. The median price of this week's pending home sales is just under $390,000. And that is basically unchanged for 3 weeks in a row. It is just a tiny fraction higher, less than 1% above last year at this time. So the blue line is last year and the purple line is this year. And you could see in the spring has the best inventory. It has the most buyers and the greatest demand. So home prices climb in the spring, they peak in June, and then they start tapering for the second half of the year. So there's a few lessons we can draw from this data. In June 2022, we were coming out of the pandemic. Mortgage rates went from 2 to 3 to 4 to 5 to 6% super rapidly. And so if you hadn't bought a house by June, If you didn't get your deal, people were scrambling to get their deal but done back here, and it was driving home prices up. If you didn't have your deal done, then people backed off. And then by July, they only were buying things that were a bargain. So we saw home prices did a big dip in June and July of 22. So that was the first bit coming up. Then in September, October 22, mortgage rates jumped again to 7.5%. And that was a big surprise. And that froze buyers cold. And so we could watch literally in a few weeks, home prices drop again. We had a little bit of, we had those dropped. And so year over year by 23, we had a few months here with home prices of 23 below 22, the teal line here lower than the green line. So we could see that for a few months, and we could see it coming because of price drops back here in October, September and October. But we had a little resilience in 23. So we had some buyers, and we had year-over-year comparisons at the end of 23 that were allowed us home prices to grow by the end of the year. Last year, we hit our mortgage rate low in September, and look what happened to prices. Prices kicked up and stayed resilient through the end of the year because of this 6% glimpse we saw in September. That really surprised me how quickly home buyers were responsive to that deal, but it held prices elevated. And so home prices ended the year about 4 or 5% greater in 24 than in 23. It was a big surprise. So that tells us right now, if we stay on this curve where mortgage rates stay in there 6%, 6.5%, we're probably going to come in here, float right along, and be essentially unchanged or maybe a little bit below last year. If we get lucky and rates dip a little bit more, that could give some resilience to prices, so we have some acceleration like we did last year. But 6.5% wasn't enough. It was 6% before we saw the needle move last year. So that's really what we're watching for here. And the other thing is true too. If we were to get a spike to 7.5, like we had here and here and here, I would expect home prices to drop notably in that time, and that would be a significant change for your buyers and sellers to hear in the headlines. So home prices are barely appreciating over last year. They are very sensitive at this point to that rate move. The other new variable we have this year is that we have potentially shifting vibes on the economy. So in 23, we had a little bit of rate boost, and people were not worried about their jobs. And so they were able to be resilient and buy some more houses and keep prices up a little bit when rates dropped. If rates drop now because unemployment is spiking, that could be a very different equation than we've had. And that may be that suddenly home buyers are more sensitive, shifting their attention to things like unemployment than they are to mortgage rates. So that could be a different variable than we've had to deal with in like 15 years in this housing market. It'll be really fascinating to keep our eyes out for that. So that's the weekly pending home sales. Home prices, that's the price of the weekly pending home sales. So there are now 5 states that have negative home prices over 2024. It is Texas, Georgia, South Carolina, Montana, and Washington. Now, and there's a few others. You can see Florida, Louisiana, Iowa, South Dakota, and Arizona that are very close. And in fact, Colorado, I think, is probably is one that is at the most risk here too. By Tennessee, so there's a bunch more that are barely positive and trending lower. So I did this chart so the greener the state here is, the more appreciation. The redder the state is negative. You can see up here in the Northeast where inventory is still tight. New York is 12% home price growth. Connecticut is 8 or 9. So we can see these markets up here that have the most home price appreciation over last year. In a few minutes, I will spend time with a city from most of these local markets that are negative and a couple that are mostly positive. But what we have here is you can see rising inventory, you can see slowing demand, and demand that is not yet picked up. These are what we're looking at here are the median price of the weekly pending home sales. So it's this week's newly pending home sales. What's the price in and where have they gone? So we did this map in February, 1 month ago, and it was only 2 states. Now it's 5 states. So it is absolutely worth paying attention. It is the current trend, and this is why I say we could be in the second quarter aiming for a world that has rising home sales and declining home prices nationally. So home prices nationally are just barely positive. They've been bouncing about 2% appreciation. We still have a lot, but most of the homes in the country are in Texas and Florida. So if these states are negative, then that really drives the national average down. It's Texas and Florida, then California. Even though California has way more people, California has a chronic shortage of inventory. So it is, and then there are states like North Carolina and Ohio and Michigan and places like that in New York. So as of right now, there are 5 states with negative home price appreciation, and we're going to dive into some of those local markets. Before I do the local markets, I like to look at the leading indicator for future sales prices. And when we look at the percentage of homes on the market with price reductions from the original list price, there are now 34% of the homes on the market right now that have taken price cuts from the original list price. You can see that that's more than last year. It's more than any year in recent decade. So that tells us that there is obviously demand has been slow. It was significantly slower in the spring than we'd hoped because mortgage rates stayed higher longer than, in the fourth quarter last year. We were hoping that and expecting that rates would start easing down, and they didn't yet. So you could see that price cuts started ticking up in February this year, when some years like in 23, price cuts, this was an improving market in 23 as it dips down here because then rates were improving, and we could see that price strength was going to show up later in the year. We don't have that improving market conditions right now. So it looks to me like price weakness shows up later in the year. The other thing we have to watch in this chart is the steepness of the change. In 22, back in March of 22, only 16%, 17% of the homes on the market needed price cuts. Now rates started rising, demand was falling, and every week there were sellers who didn't get the offer, and so they needed to cut price to spur demand. And so when this was happening in April, May, June, this rise of price reductions, the message here was to sellers, you want to be in front of this curve. You don't want to be behind this curve. You don't want to, if you are thinking about selling your house this spring, if you are in the camp that we've heard anecdotally about people who are like, I want to sell my house before it gets worse. We're in elevated price reductions now, and those are rising. So that means you don't want to take the opportunity. You don't want to try the strategy of overpricing your house in this market. So, there are obviously 2 common listing strategies. One might be to overprice and do a price cut if we don't get the offer. The other might be to underprice to generate demand and maybe even get a bidding war and sell higher. In a rising price cuts world, you don't want to try the overprice strategy. So that may be a very important message to give to any potential sellers right now. We want to price the house properly to allow it to move. The other thing that's happening is if they're not getting the offers, a lot of folks have their cheap mortgage, so they are withdrawing and say, I'm still not going to sell my house. So withdrawals are pretty high too. So it's not just the price reductions, but withdrawals are pretty high. And so that implies that all of those things um, are indicators of weak demand, which indicate price, at least a ceiling on prices in the future, and maybe even outright price declines. It's really something to watch, and we're going to look at the local markets in a sec. And we're final on prices. Here's where we are winding up our forecast. So our forecast for the end of the year is for 3.5% home price gains year over year. That's lower than the long-term average. Over many years, home prices in the US gain about 5% per year on average because we generally underbuild. We have a generally growing economy. We have generally growing population. And those things lead to about a 5% year over year gain. So a 3.5% means we have a weak year for home price demand. And this is where this is the trend we've been in this year. So this move is a pretty significant drop in the year over year home prices. So right now we've been bouncing around this 2.5% range. So this implies to me that we still need slightly falling rates for this year, slightly improving demand, and not a surge in home sellers. We're starting to get a rise in home sellers. And so I'm watching this very quickly to see if we have to adjust our forecast for the year. I noticed that Zillow this week just announced that their forecast for the year went from 3.5% down to like 1% home price gains. And it's something that is absolutely on the table for us too, especially if the purple line, which is this is each week coming in. If that starts dripping down here below 2%, that's going to be something that's going to drive the numbers for us. As of right now, we're still forecasting our 3.5% gains for the year. And that assumes that like the forecast for mortgage rates still tick in, and things like a slowing economy don't confound buyers and slow it down from a different direction. Okay. By the way, I've also included some rent data here. We have rent appreciation over a bunch of years. So this is yearly rent appreciation. Right now, it is rents on single family homes are basically unchanged from the year ago. And apartments are just barely positive. And so you could see it's been well over a year since we've had any rental appreciation. And I just thought I would share that because it's like another bit of data that we have. It's really about household formation. So they're moving and they're either going to buy or rent. So home prices and rents tend to move together. They don't move opposite. It's not like, oh, I'm going to buy or I'm going to rent. So rental demand does not improve when purchase demand falls. So I think it's really fascinating that we are really at just about flat on rents for the year. And that has implications for things like the inflation numbers that are coming in several months. So just something that we can watch. Okay, before I get to the last bit here, I'm going to switch to the Altos local data here. Share there. And I have up here my Altos advanced analytics page. And I have a bunch of queries set up that I like to track home prices by state, the 45 biggest metro markets. Here's our price cuts. So I was just talking about price cuts. Normally for the country, about 30 to 35% of homes taking a price cut is normal. So markets that are at 54% or 50 or in the upper 40s, these are slow markets, and this has weakness implications for the future. Phoenix is the first non-Florida market in there. Phoenix has a lot of rising inventory. Phoenix has a lot of investor buyers. Phoenix has a lot of international buyers. So it'll be really fascinating to see if this contributes to a rise in price reductions in Phoenix as the year goes on. I should say, though, Phoenix is normally in the low 40s. So where the country is normally about a third of homes take a price cut, in Phoenix is more like normally about 40% do. And so 40 to 49% is not a ton of space. It's not super bearish for Phoenix, but it's a really noticeable thing in the whole Florida set. There's Tucson. The Texas markets will then come in next. And Colorado is one that I'm paying attention. So as I mentioned, Colorado still has positive home prices year over year as for the state, but I expect that it'll be shifting negative very soon. So what I did was I have a few of the bearish price states up, and I mentioned it's Texas and Georgia. I've got Florida and Seattle up, but let's start with Denver. So Denver has rising inventory, significantly more homes for sale than any time in a bunch of years. We can look at the implications on home prices in Denver. So Denver here is the home prices year over year decline. So some of the rest of the state is still barely positive. But if you look at this, we look at the momentum for Denver, it implies to me that we'll see Colorado in those home price decline states in the next month or so. And if I look at price reductions in Denver, you can see that price reductions are currently higher than they have been in a bunch of years. So that implies future transactions are under price pressure. So, and when I talk about that, like a home is on the market now, and if it doesn't get an offer, it does a price cut now, and then it gets an offer in April, and that's a sale that completes in May. And so by price reductions being elevated now, we can really see the transactions out in May where that might be an impact. Now Denver's still, it's really interesting. Things are moving pretty quickly. So still a month, you can see at the low end in Denver is where the weakness is. So Denver is one of these places where we could see home sales rise, but home prices inch down in the coming year. Now, Georgia already is showing home price declines year over year. And so I'm looking at Atlanta here. And so we can look at the prices in Atlanta. And in fact, let's look at the 90-day rolling average here. We can see home prices from 425 last year at this time to 415. So just a couple percent lower. But contrast that to, a bunch of years of really dramatic rises in price there. We can see let's look at inventory in Atlanta to see if we can see. So Atlanta is getting back to the old normal levels of unsold homes on the market. It is really for the first time now back to where we were back in early 2020, just before the pandemic. So, supply is limiting. Supply is the ceiling is lifting in the face of flat demand, and that has those price implications. Here's let's look at price per square foot, and so you can see, the price per square foot turned sideways 3 years ago, like on a dime. The price appreciation stopped in Atlanta. Atlanta's notably slower to sell homes than Denver. I think that's interesting, but also it's a nice diverse market, and so the high end isn't like dramatically higher like some markets, and the low end isn't dramatically lower. So you have a lot more evenly distributed demand across the Atlanta metro. Dallas is one of the markets that's been the weakest we've seen in several years. So Dallas home prices here, climbed all the way through the pandemic. Dallas was 455 last year, is 440 now. So that's a 3% home price decline year over year in Dallas. Dallas is a diverse market, roughly about the same price point as Atlanta, those big cosmopolitan markets, and the time to sell is really about the same there. Let's look at the price reductions in Dallas and see if we can get any signal there. So in Dallas, as I mentioned, in 22, this was the first spike of rights, and it was like the homes that were listed for sale here had to get, they were trying to catch up with demand cratering. So Dallas peaked at 52% price reductions in November of that year. Right now, though, we are a higher March than we've had in any recent year in Dallas, meaning there's fewer buyers, there's more future sales price pressure in Dallas. So if you're listing a house in Dallas right now, you want to be ahead of this curve, not behind it. Let me switch over to some of the markets that are on the upside. So Connecticut has inventory, dramatically lower inventory than the before the pandemic. And look at inventory. So I just opened Bridgeport, Connecticut. There's only 40 homes for sale in Bridgeport. So this is a town rather than a whole metro market. But look at the inventory levels. We stopped selling houses in Bridgeport, Connecticut in March of 23, and we've held on. And as a result, the homes that are above 500K are going in 35 days. In the 400K, like this section is 14 days. So you can see that. And now check this out. So we were looking at those price curves for like Denver and Dallas. Look at Bridgeport. And so because inventory is still restricted, look at that price curve over those 5 years in Bridgeport. Like that is why home prices are still appreciating, because inventory is still super light. Okay, I don't have time to get to all of the local markets today. If I didn't get to your market, you can go to Altos and you can book a free account. You can go set up your first zip code. And I'm showing here a little demo of what you get in the Altos system. You can go get your local markets. You have a little dashboard to see all your local markets. You can quickly grab your report to send it to your contacts. This is cool stuff. If you haven't logged into your Altos report into your Altos account lately, I encourage you to do so and see the team is really working fast and doing a bunch of cool new features. There's new features and advanced analytics. So I encourage you to check them out. I don't have time to get to all of the reports to local markets. So the best way to do it is to go to Altos and book your report, get your report and your account set up today. All right, everybody, that's all the time we have for today. I appreciate you with me. I'll stick around and then we'll make sure the chat is answered, and the recording will be available and emailed to all the registers later today. Thanks, everyone.